Beneath the deep clay layers of the Nevada desert, a company that had once gone unnoticed has suddenly drawn the attention of the global capital markets. Its name is American Battery Technology Company. Founded in 2011, the company has only 98 employees. Yet within just a few months, its stock price surged nearly fivefold, and its market capitalization has exceeded $400 million. However, when we look beneath the surface of this explosive growth, we find a company with only about $4 million in annual revenue, over $45 million in net losses, and a single pilot recycling facility operating in Nevada. So the question is, how has a company with such a fragile financial structure managed to achieve such a dramatic surge in market value and simultaneously receive strategic support from the U.S. government? At the heart of this mystery lies the Tonopah Flats Lithium Project, a clay-based lithium deposit in the Tonopah region of Nevada. The site includes 517 unpatented mining claims covering approximately 16,000 acres, and the company has claimed the presence of around 15.8 million metric tons of lithium carbonate equivalent. This represents one of the world's largest known deposits under a single project, with the potential to stabilize the global lithium supply chain for electric vehicles over the long term. This potential has also influenced the policy decisions of the U.S. government. In June 2025, the project was designated by the Federal Permitting Improvement Steering Council under the White House for the FAST 41 program, a federal framework designed to fast-track permitting for major projects. The FAST 41 designation is intended to dramatically reduce the years-long permitting process that is typical for large-scale industrial developments. However, in most cases, eligibility for the program is limited to projects that have already demonstrated technical feasibility, business viability, and at least a foundational level of commercial readiness. Yet in this case, the company was designated despite not having even broken ground on a commercial refinery, a rare exception. Such a precedent is highly unusual and has led to speculation that geopolitical strategy or national lithium security interests may have influenced the decision more than purely economic logic. Additionally, at the end of April that same year, the company disclosed it had received a letter of interest from the Export-Import Bank of the United States for potential financial support of approximately $900 million. But this, too, raises questions. The letter is not a binding loan agreement. Rather, it is a non-committal document indicating a willingness to evaluate the project. Numerous steps of due diligence remain before any funds can be disbursed. Typically, such financial support is extended only to projects that have secured offtake agreements, demonstrated technology, and provided clear data on yield and recovery rates. Yet, American Battery Technology Company has not disclosed any commercial contracts, nor has it begun construction on a commercial-scale refining facility. Another point of concern involves the company's reported recycling facility in the Tahoe-Reno Industrial Center. The facility is described as having the capacity to process 20,000 tons per year. And in April 2025, the company claimed it had transitioned the plant to full-time operations, doubling its quarterly output. However, in the official annual report submitted in September of the same year, the total revenue generated from this facility was still just around $4 million. For a facility of that size operating under normal conditions, this level of revenue could typically be achieved in less than 2 weeks. This discrepancy raises serious doubts about whether the facility is truly operating at full commercial scale. If the facility was indeed running continuously, why was revenue so low? Possible explanations could include technical limitations in the production process, incomplete installation of key equipment, or delays in securing downstream buyers. But the company has not provided concrete data to clarify the issue. To add to the complexity, the company filed a shelf registration for up to $250 million. This allows them to issue new shares at any time to raise capital from the market. For a company with unstable revenues and mounting losses, using shelf registration to fund infrastructure development is not unusual, but it does introduce the risk of share dilution for existing investors. In essence, this reveals that the business model has not yet generated cash flow and that significant external capital is still required to sustain operations. Despite all of this, the company maintains its ambition to extract lithium directly from the Tonopah clay deposit and build a facility capable of producing 30,000 tons of battery-grade lithium hydroxide annually. However, construction has not yet begun, and no detailed data on pilot-scale yields, product purity, or commercial pricing has been disclosed. Ultimately, the entire plan rests on a single word: lithium. So the question remains, is this company truly on the path to becoming one of the world's largest lithium producers? Or is it simply using government grants, resource estimates, and unfulfilled technological promises to shape market perception? The answer may still lie buried beneath the clay layers of the Nevada desert. This was ValueStir.